2008, the world was shaken by a real estate crisis that few saw coming. At the heart of the 2008 financial crisis lay a series of intertwined factors that, together, triggered one of the greatest economic upheavals in modern history. It began with a housing bubble, fueled by an unprecedented surge in home prices and a wave of high-risk mortgage loans, known as subprime, offered to buyers with questionable credit histories. This situation was exacerbated by an era of financial deregulation, which allowed banks and financial institutions to take exorbitant risks, including investing in complex financial products linked to these high-risk mortgages. These instruments, such as mortgage derivatives and mortgage-backed securities, were enigmas even for those who managed them, wrapped in a complexity that few could unravel. The breaking point came when subprime mortgage borrowers began to default en masse on their payments. This triggered a steep drop in the value of mortgage-backed securities, hitting banks and investors who owned these assets hard. Renowned financial institutions, like Lehman Brothers, found themselves on the brink of the abyss, some falling into it, which in turn exacerbated the crisis. This financial chaos unleashed widespread panic in the markets, leading to a freeze in credit lines and affecting the global economy. The result was a crisis of a magnitude not seen in decades, a crisis that resonated in every corner of the planet, affecting individuals, businesses, and governments alike. Now, in 2024, the echo of that disaster resonates once again. Just like in those dire days, we are seeing alarming signs in the housing market that we cannot ignore. The limited supply of homes, an increasingly pronounced phenomenon, is pushing prices skyward, a disturbing reminder of the unsustainable boom we witnessed before the collapse of 2008. Could this housing shortage be the precursor to a new real estate bubble? Statistics suggest a steady increase in home prices, and although experts insist that the situation is different this time, isn't that exactly what was said before the last major crisis? In addition, affordability has become an empty word for many potential buyers. Young people, in particular, are being pushed out of the market, forced to take extreme measures such as forming intergenerational households just to have a roof over their heads. This bleak picture of despair and exclusion is reminiscent of the days leading up to 2008, when home ownership became an unattainable dream for many. And although lending standards are stricter compared to 2008, the question persists: is it enough to prevent another catastrophe? History often has an ironic way of repeating itself, and the patterns we are seeing in 2024 are ominously familiar. The pressure on the housing market is creating a breeding ground for uncertainty, fueling the fear that we are on the cusp of another catastrophic crisis. In summary, as we face 2024 with a mix of hope and anxiety, we cannot help but look back to 2008 and wonder, are we destined to repeat the mistakes of the past? The housing market, once again, is at a critical crossroads, and only time will tell if we have learned the lessons of history or if we are doomed to relive them. On the threshold of 2024, we face an invisible but omnipresent threat in the financial markets: permanent distortion. This term, coined by economic experts, describes a chilling reality in which financial markets have alarmingly detached from the real economy. At the center of this distortion is the Federal Reserve, which has injected a staggering amount of $9 trillion into the financial system. Like a puppeteer pulling the strings of the market, the Fed has created a situation in which markets have become addicted to easy money. This dependence has distorted both the perception and the reality of economic value, creating a bubble that, if burst, could plunge the world into financial chaos similar to that of 2008. The ever-widening gap between paper wealth generated on Wall Street and economic health on Main Street is a warning sign we cannot ignore. Are we perhaps walking a tightrope over an abyss of economic uncertainty, waiting for it not to break? The danger of this permanent distortion is that, like a latent virus, it could trigger devastating symptoms at any time, leading markets and the economy into a spiral of disaster. This scenario raises disturbing questions. Are we about to witness another massive transformation in the financial markets, one that could crumble the foundations of our economy? permanent distortion is a reality that we must face with open eyes, aware of the danger it poses to our financial future. And now, let's delve into an even more ominous omen for 2024, the imminent threat of a recession. Top-level experts, such as UBS, have issued a chilling warning. The U.S. economy is on the edge of a precipice, with a recession that could hit as early as mid-2024. This prediction is based on a rigorous analysis suggesting that the Federal Reserve, in a desperate attempt to revive a faltering economy, may implement drastic interest rate cuts, plunging rates to astonishingly low levels. What does this mean for the average citizen? We might be witnessing the return of an era of cheap money and easy credit, a breeding ground for risky investment decisions and speculative bubbles. But the real question is the economy truly prepared to withstand another round of monetary manipulation, or are we simply applying a band-aid to a wound that requires surgery? Even more alarming is the context in which these forecasts are being made. We are entering an election cycle in the United States, a period where, historically, economic concerns are often eclipsed by political maneuvers. This neglect could lead to an even greater disconnect between economic policy and market reality, leaving the economy in a vulnerable state. Therefore, we stand at a critical crossroads. The prospect of a recession in 2024 is not just a possibility, it is a prophecy that seems to be fulfilling itself in an increasingly predictable cycle of boom and bust. Will we witness a repetition of the mistakes of the past, or will we find a way to navigate these turbulent economic waters with a new understanding and approach? Only time will tell, but one thing is certain: the shadow of 2008 looms over us, reminding us of the lessons we have yet to learn. And now we enter into the third critical point that foreshadows turbulence in 2024, the worrying fragility of the financial sector. Remember that in 2023, the world witnessed the fall of banking titans such as Signature Bank, Silicon Valley Bank, and First Republic Bank, an event that shook the foundations of confidence in the financial system. Although these giants fell into oblivion, the fragility persists, like a wound that has yet to heal. This panorama not only takes us back to the collapse of Lehman Brothers in 2008 but also alerts us to a possible repetition of history. Banks, although seemingly solid, are in a precarious position, balancing on the edge of a financial knife. Interest rates, expected to be cut in response to the recession, may temporarily alleviate pressure, but they will not cure the underlying illness. The big question looming over us is, are we on the verge of another banking crisis? The answer may lie at the intersection of monetary policy, risk management, and market psychology. The fall of these banks in 2023 could be just the tip of the iceberg, a harbinger of a broader collapse that could trigger a chain reaction in the global financial system. In this context, 2024 not only presents itself as a year of economic uncertainty but also as a minefield for the banking sector. The combination of shifting monetary policy, volatile interest rates, and a globally interconnected economy could create the perfect scenario for a financial storm of epic proportions. As observers of this financial drama, we must ask ourselves, are we prepared for what may come? Or are we destined to be passive spectators of another financial catastrophe looming on the horizon? The answers to these questions could define the course of the global economy in the coming years. Furthermore, we find ourselves in a scenario that could accelerate instability in 2024, the troubling state of the commercial real estate market. The 2008 crisis, with the fall of major banks, was just a prelude. Now, we face a perfect storm in the commercial real estate sector, one that eerily resembles the conditions leading up to the 2008 crisis. History shows us that when commercial real estate markets stumble, the repercussions can be devastating. With high interest rates negatively impacting this sector, we have seen a 22% decline in commercial property values since early 2022. But what's even more alarming is the possibility that this situation could trigger massive bank losses, potentially adding up to $160 billion, an echo from the past that we cannot afford to ignore. This bleak outlook not only puts banks and investors at risk but also threatens to unleash a new banking crisis. We are at a moment when the collapse of the commercial real estate market could be the catalyst for a chain reaction that would destabilize the entire financial system. The question that now haunts us is, will the commercial real estate market be the trigger for the next major financial crisis? Will we witness a repeat of the catastrophic collapse that shook the world in 2008? The commercial real estate sector is at a critical turning point, and what happens in the coming months could have far-reaching implications for the global economy. As if all of this weren't enough, there is a factor that could be the catalyst for the next financial crisis: the growing trend towards sustainable investing. In a dramatic twist of events, 2024 is shaping up to be a year where a focus on sustainability could reshape the financial landscape as we know it. The increasing interest in environmental, social, and governance (ESG) practices is driving both individual and institutional investors to re-evaluate their portfolios. This shift towards sustainable investments, while positive in many aspects, carries the risk of creating new bubbles in green sectors. Accelerated demand and capital flow into companies and industries perceived as sustainable can artificially inflate their value, triggering speculative dynamics reminiscent of past bubbles. The enthusiasm for sustainable investments also raises questions about the long-term stability of these emerging markets. Are we witnessing the formation of a bubble in sustainability similar to the tech bubble of 2000 or the real estate bubble of 2008? If capital flows excessively into these sectors without proper risk assessment and real value evaluation, we could be laying the groundwork for a financial collapse. Therefore, in 2024, we are not only challenged to be mindful of the environmental impact of our investments but also to be cautious about the potential for a sustainability investment bubble. This emerging focus on finance, while well-intentioned, could have unforeseen consequences that resonate throughout the global economy. And there's one more point, one that few are considering: the rise of investments in remote work and connectivity technologies. In 2024, companies offering solutions for remote work, cloud services, and reliable connectivity are becoming the new El Dorado for investors. However, this unchecked trend towards digitization and remote work, driven by the pandemic and perpetuated by changes in the work culture, could be brewing its own crisis. History has repeatedly shown how excessive enthusiasm in a sector can lead to inflated valuations and unrealistic expectations. Investment in remote work technologies is growing at a dizzying pace, driven by seemingly endless demand. But is this explosive growth sustainable? Or are we on the brink of a tech bubble that could burst with devastating consequences for investors and the economy at large? The risk is that, in the rush to capitalize on this trend, economic fundamentals may be ignored and stock prices artificially inflated, creating a dangerously similar situation to the dot-com bubble of the early 2000s. If this bubble bursts, it will not only affect investors but also potentially have a significant impact on the job market and the global economy. Therefore, in 2024, we find ourselves at a crossroads. The adoption of remote work technologies is an inevitable and necessary evolution, but investor fervor in this sector could be creating the conditions for a future financial collapse. This is a crucial reminder that, even in the era of technological progress, lessons from the past should not be ignored. As we venture into the uncertain waters of 2024, it is crucial that we keep our eyes wide open to the warning signs around us. We have explored a series of concerning factors together, from the persistent distortion in financial markets to the potentially unsustainable surge in the remote work technology sector. Each of these elements, in its own way, could be a harbinger of an impending economic crisis, reminiscent of the shadows of the 2008 collapse. But all is not lost. These turbulent times also offer an opportunity for caution and action. It is a moment to be critical of our investment decisions, to question the sustainability of emerging markets, and not to forget the lessons learned from past crises. As individuals and as a society, we have the power to influence the course of our economy through our choices and actions. I invite you to join this crucial conversation and be an active part of a more informed and resilient economic future. Share your opinions, engage in dialogue, and stay informed about economic developments. Don't forget to subscribe to our channel to continue receiving in-depth analysis and updates on these critical topics. With that, I bid farewell not as a prophet of pessimism but as a messenger of caution. Until next time, stay alert and financially wise.